Hey everyone, today I want to talk about some smart things to do in a down market. This year, 2020, has given us some major market downturns, and we've recovered at this point, but I want to talk about what to do and what should you do when markets are jumpy and turn down. After a long spell of positive returns, it could come as a surprise to be reminded that volatility for stock market prices go down as well as up. The truth is, such movements is practically guaranteed. It's guaranteed. You cannot control the markets, but you can manage how you react to these changes. The key is to zoom out on any particular period and focus on the long-term trend. Let's take a look at this chart. I like to call this chart Turbulence Can Distract You. It runs from 1982 to 2019. It does not include 2020. The gray includes the movement of the S&P 500 over this period of time, which is the 500 largest stocks in the US market. And you can see that. You can see that the index has increased almost 19 times since that period. Now the black is the volatility, and the left is the 30-day average of the volatility. It's the movement of stocks. And it starts there with a big spike on Black Monday in 1987. A lot of volatility in that time. And you move forward, 2000, 2002, the tech boom and the bust, some major volatility there. 08, 09, you see the global financial crisis. And in spite of all of that volatility, you would have missed out if you had exited, if you had just followed the volatility and exited. So we're trying to talk about the importance of a long-term thinking, longer than a year. Volatility can also provide great opportunities to rebalance your portfolio and change your strategic asset allocation. Volatility in the market can make it possible for you to sell concentrated positions or high-cost active holding with no tax penalties. You can plan for such opportunities and take advantage of them when they appear. Both of these considerations about volatility underscore the importance of having a financial plan and understanding your goals. And this can set your financial North Star and can be a constant reminder to remind you that you can be successful independent of market conditions. So here are smart things to do in a down market. You could also call this smart things that many people won't do in a down market. So here we go. So one of the most unsettling aspects of market downturn is the feeling that you are out of control. Markets move based on numerous variables that no one person can fully monitor or control. When prices falter, the resulting steady drumbeat of negative news can cause many investors to flee the market out of fear. When others are pessimistic, that's the best time to reframe the situation to one of optimism and opportunity. If you follow these suggestions, you will be successful. So here are the 6 suggestions to be successful. All right, so number 1, tune out the noise. It's okay not to check your portfolio balance when the market is falling. Turning off the financial news might be smart if it keeps you from making mistakes based on emotional decisions. Number 2, revisit your asset allocation. If you happen to be near retirement or in retirement or lose sleep in a downturn, you may need to reevaluate your risk tolerance. Talk to your advisor and figure out the right balance of stocks and bonds best suited for your comfort level, with risk and other personal circumstances taken into consideration. Number 3, control what you can. Expenses eat returns, and their bite is particularly painful during market corrections. consider removing high-cost investments from your portfolio and control the costs that you can. Number 4, set realistic expectations. U.S. stock market and bond market prices have posted remarkable returns over the past few decades. Realistically speaking, it would be prudent to expect lower returns in the future. So the idea is to develop your plan based on lower expectations so that you end up with realistic results. Overpromise, underpromise, and overdeliver, as they say. Number 5, fifth thing to do in a market downturn is to stay diversified. Downturns offer case studies in how different asset classes and sectors offer different performance during market downturns. So conversations about risk tolerance help to figure out your investing style and what's important for you. With better insight, you can create portfolios that blunt the downturn and put you on track to achieve your financial objectives. So there are 5 things that are smart to do in down markets. So thanks for stopping by. Thanks for listening to this message today. If you would, subscribe to the channel, hit the bell to hear about updated videos we're coming. Thank you so much for stopping in and listening to this message. I'll talk to you again soon. Bye for now.